So I spoke to Drew Harwell from the Times. Tampa Bay home prices hit a 5-year high, but realtors question how long they'll climb. My exact quote to him was, with interest rates rising, some of the cash investors slowing down, it's actually causing some sellers to start to fence sit, expecting prices to maybe going up even more. And we're not in 2005 anymore. We don't have the economic fundamentals. We still got high unemployment, low wages, a lot of foreclosures to get through. But ultimately, there's a lot of people out there starting to think that we're right back on the gravy train of 2005, and there's still a lot of economic data that points the other way. Again, we've had some local things that have made our market look really healthy and healthier than it probably really is, somewhat artificial and short term. But in the long term, there's still a lot of things to get through for our market to keep stabilizing. And again, like I told Drew, I think that we are going to see in the second half of the year a little bit of a dip in price, not as many home sales, and this kind of escalation that we've been seeing, I expect to slow down. I think the first aspect that's really pushing that is, interest rates. I mean, interest rates went from, the threes up into the mid to high fours. I mean, in a matter of weeks. So, the fact that happened that quickly, it's going to do two things. It's going to eliminate home buyers, some of them, from the market, because what people don't realize, they hear, oh, interest rates went up 1 percentage point, and they think, oh, they only went up 1 percentage point. But in reality, if they go from 3.5 to 4.5, your payment just went up more than 25%. I mean, or not quite that much, but it went up substantially. So it's not 1 percentage point. While it sounds like not very much in the grand scheme of things, if you look at it from a just purely a ratio standpoint, it's a big increase in the payment and the cost of the house for people that I think a lot of people are failing to think about. Like, so for example, if you had a $200,000 mortgage and you went from 3.6 to 4.8, your payment would go up $140 a month. It would go up approximately 15%. Your payment would go up approximately 15%. So it's more significant than people realize, and I think you're going to have people that have been looking and have wanted to get into the market when interest rates being where they are. It's forced them out of the market, or it's forced them to buy a lower priced home. And every person that we eliminate from the market, it eliminates multiple transactions. Just like the large investors, if they slow down, you pull away their initial transaction, it's a domino effect to the $200,000, the $300,000, the $400,000, the $500,000 sales. The same thing can happen with first-time home buyers and people that are really dependent on that low rate to be able to buy. So, and I think locally, the other thing that we've got, so not only have rates risen, but whenever people have a hard time emotionally responding to changes in the economic environment. So when you have a consumer that's been out there looking for so long, and the rates are low, the market's in their favor, everything looks great, and then all of a sudden we see this shift, it actually causes people to emotionally detach and sit on the fence. They get scared. Yep. They're not used to the change. They don't know what to do, and it causes gridlock in a sense for certain people that have been looking. We've had it happen in the past few weeks. We've had consumers that have looked and looked and looked and looked, and now all of a sudden, and they have the ability to buy. They can qualify. They can afford the higher rates. But all of a sudden, all this discussion starts happening about higher rates and shifts in the market, and they get spooked. Because for the majority of real estate purchases, it's a very emotional decision. I mean, we like to think that it's math and it's investment, and it's all about the money. But a lot of people, this is their home. They're buying for emotional reasons. And some of these changes can really cause a slowdown, not because they should or shouldn't slow down, but because emotionally they're having a hard time dealing with it. So the timing of the market, there's certainly buyers still not sure whether they should wait or whether they should jump in now. And certainly first-time home buyers are being impacted because they've had to compete with these large institutional groups, and now interest rates going up. It certainly bodes for, I think, in the second half of the year, we're going to see real estate statistics that don't look as good as they looked in May. I mean, in May, for example, we saw appreciation from the early part of the year to now of more than 15% in the average price. I think we're going to start to see some slowdown. I told Drew that, and I think that if we look down 2 or 3 months down the line, we're going to see some figures that aren't as sexy as the numbers that we're seeing right now, because the fundamentals just aren't there. There's a lot of things driving our market that's very artificial.